April was a month of extraordinary reversal. What began under the shadow of the Iran conflict that had rattled markets in late February and March ended with one of the sharpest US equity rallies on record. The defining event was Trump's announcement of a ceasefire between the United States and Iran, which reopened the Strait of Hormuz and unleashed a wave of risk-on sentiment, leading to the fastest market recoveries in history. However, despite the resolution, consequences from the elevated oil prices and blockade remain. In the US, equity markets had the fastest recovery from a drawdown in S&P 500 history. The S&P 500 fell 8.4% from the first strike on Iran at the end of February till the low in early April. The S&P 500 then rallied 17.8% to fresh highs once the ceasefire was announced. The chart shows how the S&P 500 performed during this period. The speed of the recovery is what makes this drawdown remarkable. The S&P 500 recovered its Iran conflict decline in just 11 days. The Liberation Day recovery was only 55 days. The S&P 500 gained 9.68% and the Nasdaq 100 up 14.31% for April, with the Nasdaq's monthly move marking its best month since 2020. The rally was narrow and almost entirely concentrated in technology, with semiconductors leading the charge, followed by information technology and communication services. Despite the rally, US inflation could dampen the real returns investors receive. US core PCE rose to 3.2% year-on-year, up from a recent low of 2.6%, reversing what had been a steady disinflationary trend since late 2022. The green dashed line indicates the Fed's inflation target of 2%. The latest US core PCE data was significantly higher than expected. The US 2-year Treasury yields and FED funds futures repriced sharply through March and April, indicating markets are no longer pricing rate cuts in 2026. This was reflected with the Fed's recent decision to keep interest rates unchanged at 3.75%. Japanese equities also surged alongside the global risk-on tone, with the Japanese market up 10.33% for the month and now 18.46% year-to-date. European markets lagged the US for the first time this year, with the Euro Stoxx X 50 up 3.29% for the month. In the UK, the FTSE 100 was relatively flat at 0.43%, weighed down by the 10-year gilt yield reaching 5%. Emerging markets were the standout performers, with MSCI emerging markets up 23.21% for year-to-date. South Africa's story was more mixed. The rand weakened to 16.67 rand per US dollar by month end, pressured by a strengthening US dollar as oil prices, priced in US dollar, remained elevated. The chart overlays US dollar to rand against Brent crude through the conflict period. The two moved largely in lockstep as the rand is driven by risk sentiment and commodity prices. The JSE All Share was down minus 0.56% for the month and only up 3.07% year-to-date, with the Resources Index down minus 6.27% for the month, as gold and platinum gave back gains. The JSE remains significantly exposed to the resource sector, making its performance highly sensitive to global macroeconomic factors. The reliance on global macro variables is further shown as the South African Volatility Index, the JSE version of the VIX, sits at 24.81, which is meaningfully above its historical average, showing how despite risk sentiment shifting back to risk on, local risk remains elevated as global macro moves can cause sharp reversals. With the elevated oil prices and oil being priced in US dollar, there is a double inflationary risk to South Africa's 3% inflation target. Most major central banks kept their monetary policy rate unchanged at their recent monetary policy meetings. Despite the ceasefire, failed negotiations between the US and Iran keep the price of oil at $100, with oil having remained in a range of $80 to $115 a barrel. The mechanism behind the price action of oil is best seen in the underlying physical data. Daily tanker crossings of the Strait of Hormuz collapsed from around 60 to 80 per day to near zero in late February, and have only partially recovered, reflecting how effective the blockades were and why supply concerns remain front of mind. Despite oil remaining at $100 inflation pressure and the Fed holding rates firm, U.S. equity volatility has collapsed back to pre-war levels, with the VIX below its historical average. This indicates that U.S. downside protection is cheap at the moment, and investor sentiment seems to be complacent. As we enter May, history is clear that intra-year drawdowns are normal. The S&P 500 average intra-year decline is minus 14.2%. Despite this, the annual returns have been positive in 35 of the last 46 years. The Iran war reminds us that the biggest risks are the ones no one sees coming, the black swans. So how do we protect from the unforeseeable while still remaining invested? We buy insurance, true to the gray swan philosophy, building resilient portfolios that keep you invested while protecting you on the downside so you can sleep well at night.